life, your term show.
All right, Adam Niman, you are back. This is going to be interesting. There's some people, that there's some people that feel that we get too much airtime here. That's what it is. Not too much.
I feel that way as well. Don't worry.
So it's not too much airtime. It's just like, hey, because look, so for anyone listening, we're going to be talking about life insurance and really kind of a different side of it than a lot of people is the regular things that were kind of explained, because you have a differing opinion of that. And I just want to be clear before we start with this is that we've invited many people on this show to talk about this kind of topic with you. And no one really wants to take the opposing view, because we've wanted to really have an open discussion about both sides of this. And I've asked people who have turned down the request. You've asked people who've turned down the request. They're willing to have conversations individually
or
privately, yeah, off the record. But they don't really want to kind of do that. So for whatever reason, so I'm just putting that out there for anyone listening, because I don't want people to think that, hey, we're taking one side of this argument. I'm actually I got more interested in this because I'm kind of trying to dive deeper into this to try to get a deeper understanding of these things. And the deeper I went, I just felt I learned more, and it kind of altered my opinion of certain things. And that's why we're going down this path, because you can be a bit your views can be a bit controversial in, I guess, some of the insurance parts of the insurance world, because they just don't agree. Some of the insurance providers, the sales reps, I guess, don't really agree with where you're coming from.
It's really complicated, because you have one product that is sold in so many different ways that it's really hard to talk about it. Like, obviously here we are going to talk about it from a general perspective, but these things are so individual. And the reason why I want to come on again, and the reason why I think I've been on a few times with you, is because I feel like every time we talk, it pushes me to dive a little bit further and to think more deeply about what this is. And every stage that I get to, I kind of want to take that next dive. And it's getting harder and harder to do so. And what I've been trying to do as of late is speak to other advisors or insurance companies in an open forum who want to, I guess, more or less debate the things that I'm saying, because I'm after the truth here. And I want to know that every dollar I put into something is working the way I want it to, or to the best extent possible. And where I'm at right now with this is I kind of question why anyone does it at all. Mm-hmm. If not for the purpose of, I just want my wife to have a little bit of liquidity when I die. I'm not talking about term insurance here. I'm not talking about that. I'm saying in the context of permanent insurance.
Permanent insurance is participating
whole life or universal life, or even just a policy that you're paying $200 a month for the rest of your life, that's going to give your wife, your kids, or whoever it is, $200,000 when you pass away at whatever age, just for some liquidity.
And the main difference for people listening, like the difference between a term policy and these either universal or participating, is basically like
Can you put something on the screen quickly, if you don't mind?
Sure, yeah. But just so clear, term is just the insurance, like the death benefit, and the other ones have like an investment component. Is that right?
Yes.
Yeah, and I can put some. Can
you put something on the screen and I can?
Well, if it's already up here, you were supposed to say that.
No, I meant a website. Is that possible?
Well, now you're making things more difficult for me.
Actually,
what? Yeah.
Go to my website, nimanfinancialinc.ca.
If you prepped us with this would.
Sorry, you're making me think of it on the fly.
Nimanfinancial.ca?
Yeah. See, I don't know my fucking website address.
No, I did notice that, yeah. Okay, so let me throw it up here. Hold on.
Yeah, go down a little bit.
Okay, well, hold on. Now we got to get it on the screen.
You
want it shared on the screen?
Yeah, why not?
With everyone
listening?
Do it. Okay.
Yeah. Because I think this is a good way to get started.
Okay, here we go.
Maximize a little? And go down a little?
Okay.
Okay, why don't you put in my age? Put in 40 years old.
Okay, well, look, there's a lot of people that are just going to be listening to this. The majority of people will just be listening.
So you're basically, I've built a tool that effectively gives people the lowest price for what I believe are the 5 major products across the market.
Okay, so here's 40 years old, male, and how much coverage you want me to?
Non-smoker, go to $1 million.
Okay, we're choosing $1 million coverage here.
And do monthly, because I think about everything monthly. Click monthly.
Okay, and then
Perfect.
see my quotes.
Right. Now, the reason why I built this is, now there are a lot of websites people can go to. Once you go up a little bit so you can see the chart there. There's a lot of websites that people can go to research rates or whatnot. Or there's a lot of brokers that people can go to just get quotes. If you want to move up a little bit, you can see the whole chart. Up, other up. There you go. Perfect. There, that's what I wanted to see. So the problem is people will get quotes from multiple different advisors, thinking that an individual quote is going to give them more information, or some other advisor is going to give them a piece of something that they didn't see. And the reason why that doesn't work is because no one understands what this stuff is. There's no context. An example I give a lot with new clients is when you're first ready to buy a car, you know exactly where you're going, right? You know pretty much the dealership you're going to or the type of car you're going to buy because you've been comparing and contrasting cars your entire life. And just because, objectively speaking, a Lamborghini is better than a Civic, that doesn't necessarily mean you're going to go buy a Lamborghini, even if you can afford one. So what this tool does is it puts the major products side by side. So you can kind of understand how they're priced in context with one another.
So I can see here term 10, term 20, term 30.
So term 10 for $1 million around 50 a month, term 20 for $1 million 82 a month, and term 30 for 163 a month. So that's effectively money down the drain. If I don't die by the time I'm 60, that's $82 a month that is gone.
Yeah,
so,
but that's like any insurance. That's like car insurance. If you don't get in a car accident, well, it's money down the drain. But that's what insurance. That's the trade-off. That's where you
exactly
go for insurance.
But the propaganda in the industry is, don't you want to own, right? You don't want to rent your house. You want to own your house. Don't rent your insurance. Own your insurance.
So that you're calling it propaganda. So that can be.
Prevailing wisdom. I don't know.
No, yeah, sure. I just mean because some people would look at it as propaganda and they'd be like, hey, why is he using that term? It can be offensive.
I'm trying to be a little bit
offensive to some people, right?
I'm trying to be a little bit.
Okay. But so the propaganda. But when you say it in the industry, you're talking about the participating life industry, these longer term policies, not in the insurance industry.
No,
because there's lots of people that are selling these term policies.
100%. But it depends on and that's the problem. It's such a big industry. It's so broad, and based on the type of content that I consume, I see, I guess, a lot of the bullshit in my feed. So I'm compelled to really go after that stuff. But there's this idea out there that, well, if it's automatically money down the drain, I should get something that's permanent because I know it's coming back to my family.
It's not money down the drain, essentially.
Because it's guaranteed. So let's look at $630 a month. As long as I pay $630 a month for the rest of my life, it'll always be worth $1 million. Well, what people don't think is a lost opportunity of that $630 a month. If I'm putting in $630 a month every month into the index, let's say, and it does 10% a year over the next 30 years, right? I have $1.3 million. Meanwhile, if I cancel that permanent policy of $630 a month after 30 years, the money's gone. So the question is knowing that these policies in the long run, knowing that I'm better off investing my money, why do people do this at all? Well, the reason why people do it is because, well, A, they want it, right? I'm going to be, for the rest of my life, a little bit asset rich, God willing, cash poor. I like the idea that when I'm older, even though it wasn't the best investment, there's some immediate liquidity there for my wife or kids so they can deal with some bullshit in the short term.
And when you say it's not the best investment, you're basing that based on the average return that they're offering, which I believe is roughly around 5%.
Well,
it's like
this is cost of insurance. This is 0% return. This is the cost of the pure protection. $630 a month. That is the cost of the risk. There's no growth in that.
Oh, got it.
So now let's get into the layer of why wealthy people do these things. Well, eventually, let's say you have a lot of assets, you have a lot of cash, you're paying a lot of tax. You can dump money into these policies and it grows tax-free. The first type of policy is a universal life policy. I'm paying $630 a month for the cost of the insurance. Let's say I now want to put in an extra $100 a month. That's $730 a month. The policy is going to grow by $100 a month plus the returns and whatever you choose. You go to Manulife in this case, the lowest rate. They'll give you a list of funds that you can choose from, anywhere from bond funds to portfolios to equities. And you get to track the returns of the fund. And you get, as your 100-month grows, plus returns, that's all growing tax-free. Okay. And as that grows, you can use that growth to pay your premiums in the future. A good example is, let's say, $630 a month, 630 divided by, let's call 0.05. Actually, no, I'm going to do this a little bit differently. 630 times 12. The policy's eating $750 a year, $7,500 a year, divided by 0.05. I need $150,000 in this policy for it to pay for itself. So let's say over 10 years, I'll put in $150,000 in cash. It's going to do at least 5-6% a year.
And then
it pays for itself. And I can even take out a line of credit on that $150,000 that I can use for leveraging purposes. It's great because I don't have any TFSA room. I don't have any RSP room. I'm not paying tax on the growth.
But why would someone do that in the insurance policy? So in this case, we're still talking about a universal life policy.
Yeah.
So why would someone do that versus just put the money invested elsewhere? So because it grows tax free.
Yeah.
In there.
Tax deferred, right? If it's paid out as part of the death benefit, it's all paid out tax free.
Okay.
Right? So there is like a benefit there.
Yeah.
Right?
Okay.
Within reason. And I've won. My cost of insurance is about $130 a month. And when the market crashed and during COVID, I started putting $1,000 a month in. Right now, my policy is at the point that I don't have to pay for it anymore. As long as it does at least 5-6% a year, it'll keep running. Now, I do put more money in there. And as it grows, I have Duca that gives me a line of credit that I refinance every year, and I borrow against my policy.
What loan? Like what percentage?
75%.
75. Okay.
75%. So I have about a $50,000 line of credit with Duca, and I take that out and I invest that in actually my Kraken account, and I buy Bitcoin with it.
Okay.
I like the insurance for the liquidity, and I like the leverage. I get a deduction, but I want the insurance, and the insurance is only costing me $130 a month. It's not like a big policy.
And the $130 a month in that case, so you've now have enough investments in this policy that it's growing by that much, and it basically just takes that money out. So instead of like your account growing by that instead of leaving the money in, the $130 a month basically just comes off any dividends
and
or
the
growth of the funds you chose.
$50,000 there, it makes 5%, $2,500 every month. You see the growth, and every month in your statement, you also see the cost of the insurance get deducted, right?
Okay, got it. That's straightforward.
With Universal Life, you can choose. What participating whole life does is they take that investment component, and it now becomes part of the premium, right? So with a UL policy, let's say I'm putting in $1,200 a month into a UL, where $600 a month is going to the insurance, $600 a month I can buy the index or buy an equities fund or whatever you want it to be.
Okay, so for context, I just want to step back just to make sure, because there's just a lot of stuff going on here.
Yeah.
Just for people listening. So like we have this site up and we saw the term 10, term 20, term 30 numbers, and it looks like RBC with the term 10, term 20 has good rates. This one,
it's Foresters. I haven't put the logo in there.
Okay, so term 30 was Foresters.
Yeah.
That's Manulife there.
Yeah.
That's the universal, and that looks like about $630 a month. And then there's this permanent 20 pay, and that's what you're talking is.
No, it's not par. That's cost of insurance for 20 years.
Okay, so that's the cost.
Par's not in here.
Oh, okay.
Par's not here.
Gotcha. Okay, so now you're taking. So what are you talking about with this $1,200 a month then?
So let's say, generally speaking, the base premium of a par policy is around, on average, twice that of a universal life policy.
Okay, so we're using really broad numbers, but
Very broad.
But that's fine for arguments because we need a number to.
Yeah, totally.
So, okay.
So let's say what I mean is if you were to go to Manulife right now, or online, even whatever insurance company is, and get a $1 million par life pay par policy, the premiums will probably be around $1,200 a month.
Yeah, 12 or 13.
Exactly. So out of that, $600 a month is cost of insurance, and $600 a month is investment component.
Okay, got it.
Now, for the purpose of par insurance, how it works is that entire contribution to the par fund is considered your insurance premium. And at the end of the year, the par fund spits out a dividend based on the returns of the underlying fund. Now, the insurance companies talk about dividends being, or the dividend scale interest rate being something around 6%. This is what people think is a rate of return. And it is not. It's a scale. It's not an actual percentage. It actually represents a prediction. What they think. No one really knows what these predictions are. I do know that they're heavily based on the prevailing interest rate environment. But the issue is that they have historic trends that they look at, and aren't the rate of return that they're projecting based on decades of what they've seen already? Well, I don't know. You email them and they say our predictions are proprietary. We're not sharing them with you, and they're not shared across any of the insurance companies. So it's really impossible to know. But from what I do understand is pretty much your dividends are going to be a function of what the interest rate environment is. I think that's the simplest way.
It seems that's what I've been explained multiple times.
Yeah.
They don't tell you exactly how.
Which is ironic because if interest rates right now are 5%, why are we using 6%? And this is where this is the core of the issue for me, because we have numbers matter. The words we use matter. And when you tell someone they're making 6% of their money, it compels them to maybe borrow at 5%, or they think they're getting a lot more than they are. Over the long run, if you look at the internal rate of return on these illustrations, the ones I sent you as well, you'll notice that if you're lucky, the internal rate of return on your money is going to be anywhere from 1 to 3 or 4%. That's a far cry from the 6% people think they're getting.
Over the long term, it seems that way too, because by the time as the policy extends further out, your actually internal rate of return seems to drop.
100%.
It goes lower and lower.
Short term, the reason why it's a high internal rate of return, because that's what life insurance is. You're putting $1,000 a month in for the first 10 years, and if you were to pass away, that's $1 million plus. That's a crazy rate of return, because it's not an investment, it's insurance.
Yeah.
But assuming the idea is to keep this for the rest of your life, and you have a long life expectancy into your 80s or even 90s, the actual rate of return on your money is going to be significantly lower. Now, keep in mind, we don't know what the predictions are. I spoke about this on past shows. Back in the 70s and 80s when interest rates were high, who could have predicted interest rates would be so low? So that's why the dividends are so much lower on these old policies. What are the predictions that they're making for us today that are going to be like, oh, who could have thunk 30, 40, 50, 60, 70 years down the road? I don't know. Now, if you are buying into this knowing that this is the bond component of my portfolio, so I have $5 million in my corp that I want to invest, why buy a bond at 3 or 4% that I get taxed on every year when I can buy a par insurance policy that I don't get taxed on? It's going to still give me that yield, but now it's tax-free. And if something happens over the short term, it's a windfall. And something happens over the long run, then I get bond-level returns. This is the way the insurance companies position these products to advisors in an honest way. The problem is that you have an army of advisors who are peddling these products as a high-growth investment to be leveraged, where you're going to make 6% on for the rest of your life, that the wealthy people do, that all these smart people are doing. And the people who are buying into these are putting tens to hundreds of thousands of dollars a year of earnings into these policies and leaving millions upon millions in lifetime growth on the table because they think that these are high growth products.
Okay. So your issue with this is not so much it's not the products, really, because if people are getting into it for the right reasons, or they feel like that serves a purpose in their portfolio, going into it eyes wide open, that, maybe it can be for them or whatever. Yeah. And we'll circle back to that, because maybe there's like estate planning reasons for that and that type of stuff. I think sometimes that can come into play, and maybe that's a different conversation. Mm-hmm. But it seems like, to be specific, it's the way sometimes these products are positioned and sold to people. Is that right? Because I've seen the same thing, and I've questioned things, because I've seen people on, I've seen things like people on like a teacher salary, for example, and they've been sold like a pretty substantial life insurance policy. And I do the math in my head. I'm like, wow, if you're putting that much into that policy on that salary, I'm like, something doesn't add up to me. It doesn't seem like it's a match.
Well, so here's the thing. I think it's important to differentiate between how the advisor's positioning it and how the insurance companies position it. But I feel like the insurance companies are having it both ways. On the one hand, they talk about bond component of a portfolio for wealthy people who have all this money, extra cash, fine. But stop using 6%. Stop saying it. It's not a fucking percentage. Sorry to swear there, but that's simple as that. Call it what it is. This is a predictive mechanism where the money you will receive is heavily based on the prevailing interest rates at the time, right? It's scale 6, right? And based on our predictions, we think scale 6 can maintain if interest rates stay at around this level. Sun Life has a good piece that I found from a couple years ago that effectively talks about if interest rates drop down to about 1.5%, what dividend scale you can effectively consider in the context of your policy. That's fine. But if you're not getting 6% on your money, stop using percentage. Mm-hmm. Because at the end of the day, I'm sure you've heard the saying, a fish rots or stinks from the head down, right? It's, in my opinion, it starts at the top. If it's not a percentage, stop using a percentage. And everything, I believe, can flow down from there. But the insurance companies, I don't know why they're referring to something as a percentage when it isn't. If you're telling me I'm getting half a pizza, right? Here's a whole pizza. If I get 50% of the pizza, I get half the pizza. If I'm not getting half the pizza and you're calling it 50%, then it's not a percentage. Then what is it? And I think that's why, personally, what I believe, people are putting so much into these things, because they think that they're effectively getting pretty much market returns over their lifetime without taking the market volatility. And that's just not true. And they think I see a lot of advertisements, 6% on your money for the rest of your life. That's just not true. It's not going to happen.
Don't they smooth out the returns so it's close? And I know my
basically what that means is in good years, we're going to give you less. And in bad years, we're going to give you more. Just give me the market. Like, I don't know why this is so complicated.
But doesn't that mean they're getting the 6%?
But they're not, right? I don't know what they're getting, right? They're getting, obviously they're getting the surplus of the fund, right? But the podcast that you did with Jason is a good example. He talks about, well, you have equity in the company. I'm like, how many shares do I have? Like, how many, right? Why can't, when I buy my par policy, why can't I buy, let's say, Manulife? Why can't I pay for the insurance, and as part of that premium, I have units in Manulife? Like, they're publicly traded. They can issue stock, like, just buy the stock on the open market. I don't get it. Or any other insurance company. Or if you do have equity in Equitable Life, which is privately held, look at your statement. Or it's sort of mutually held. How many units do you have?
Okay, but let's go. So let's move on. Let's just take the next step.
Getting a little tangent there.
Well, no, because you've gone deeper into this, and I think that was the reason for this conversation. I'm like, okay, like you've actually. It's not to rehash the same stuff. It's like,
right.
Hey, look, you wanted for your own knowledge to go a little bit deeper and be like, let me get a greater understanding of how this money stuff would work and what the opportunity cost is on this type of stuff, especially for, I guess, specifically for people that, try to position this product as like, it's the best of both worlds, where it's like, hey, you give us your money for the insurance policy, and then you get to borrow this money back, and then you get to, do what you want with it. And it's like the best case scenario, and that's how people get rich and stuff like that.
Right.
And I've never seen, just for the record, we've dealt with a lot of investors in a lot of different spaces. I know a lot of people that do have those types of policies. I don't know a single one that has said that has been the source of any significant wealth for them.
It's not possible
in any way, shape, or form.
You need to feed it too much, like it can't.
So, so where do you want to go? Do you want to go through some of the numbers? You
tell me where do you want to go into. So effectively, what I've been trying to do is get a feel for the true loss of opportunity that people will experience if they overdo this stuff. And I'm saying this because too many of the clients that I see, high net worth or lower net worth, they are putting so much of their savings and so much of their money into these because they believe they are some wealth hack or this high growth tool. And if you just look at what the index will do over your lifetime or what it has done over the last X years and put those same premiums into a passive investment.
Okay, so let's look it up.
So let's start with let's start with a par policy. Let's go to
which one do you want?
Male age. Here, I'm gonna look it up here. Give me 1 second. Go to, I don't know, let's start with Equitable Life, male age 35, 95, 6,000 a year for 20 years. Equitable Life. Yep, go to that one.
So I'll pull this up and I'll share it.
Right, yeah. So what this is what some would consider a high cash value life insurance policy. So this is something that, it's not coming?
No, it came up over here. Let me do this.
Yeah, totally, do your thing.
Let's close this here. This is what happens when we don't share stuff as often, so.
Yeah, it's a good thing. It's like Joe Rogan. You should take the next level,
Yeah, we're far below that, but yeah, I understand.
Fake it till you make it.
Hey everyone, before we dive back into the podcast, I've got a quick shout out about the Your Life, Your Terms report. This is Tom's weekly newsletter where he and Nick share real stories, experiences, and powerful insights to help you live life on your terms. Each week, Tom breaks down the economy, real estate, macro trends, and Bitcoin, and gives you actionable steps to make these insights work for you. No fluff, no vague predictions, just a clear path to thriving no matter what's going on in the world. Tens of thousands of Canadians are already getting the real information they need to level up their lives every week. I can honestly say it's the only newsletter that I've stayed subscribed to for years. It delivers real value that keeps me coming back for more. Join us and start getting the insights and tools to create the life you want, plus entertaining and inspiring stories from Tom and Nick along the way. Sign up for free at rockstarinnercircle.com/get started and start living life on your terms. That's rockstarinnercircle.com/get started. Your first step to living life on your terms.
There we go.
Perfect.
We
okay.
can just, okay.
So go to pay here. Perfect. How this works is this is what's called a 20-pay life insurance policy. And a lot of these infinite bankers or even people who sell par for wealth and financing purposes, where the idea is to borrow against it, there's the base premium and then the accelerator deposit, right? So just, you know how in universal life you can put extra money in?
Yeah.
Or in par you can put extra money in. So what I'm effectively doing is creating...
Where are we looking? Where do you want
Yeah,
to...
keep
There's
going,
some numbers here?
Keep going. So,
Okay,
yep, stop here.
Okay.
So effectively, this is a high cash value life insurance policy where the premium to carry is $52,000 a year. You're putting an extra 40-something thousand a year for the total deposits of $95,600 a year. You only have to pay for it for 20 years.
But
and
how
then
many people are getting an insurance? So this is obviously very high net worth.
Dude, you don't
there's not many people that are putting $100,000 into policies.
It's wild. It's huge. Just to give you a sense.
So it's 20. So with this policy, just so I'm clear, and just for everyone listening, it's a roughly, what was that? It was 52 plus 40 something.
Yeah.
So it's about 95,000 a year.
52,200 a year plus 43,400 a year.
Okay, and that's committed for 20 years, and after 20 years it stops.
Yeah.
Okay.
In this example, right? You can obviously change.
And you're saying there's a lot of people that are putting $100,000 into policy? Really?
A lot, yeah. A lot.
Okay.
Now, the idea is that your dividends will continue to grow and compound for the rest of your life. And let's go down to age 100.
Which we're all going to live to now with science and AI.
Right?
I mean, this is
and
guaranteed.
If you don't understand money or numbers, or you don't invest for yourself, or you're, I don't know, a teacher on salary, right? And you say, oh my God, $30 million if I live to age 95, or 25 if I live to age 95. Holy crap, that would be wonderful for my family. And you know what? We do well. We can afford this. You're like, 25 million is a lot of money. The problem is, and then the insurance advisor sometimes will say, well, a lot of these insurance illustrations, the advisor can build in deposits into non-registered contracts. And they say, hey, listen, if you put this money into non-registered investment and you have a portfolio of some equities, some bonds and whatnot, over the long run, not only you have to deal with the volatility, but you're not that much further ahead because of the taxes, the annual taxes.
I've always heard that it's the tax-free growth of this is what allows it to be so much better, right?
Exactly. And there's an argument for that. But I also feel like a lot of people in my business, we scare people in and around the index to reinforce the existence of products that pay us rather than give people the truth in and around what their money will look like in the long run if they just passively buy the index. And I can tell you right now, I'm speaking to a lot of people now who are being shown these sorts of illustrations, maybe not $100,000 a year, but whatever it is. And they sometimes still buy these things, but the structure of the policy and the way they go about this is completely different after they have a conversation with me, because they realize how much money they're leaving on the table. So if you go down, this is based on current dividend scale interest rates. Why don't you go to page 15 for me? 15, go down.
Yeah, I'm looking for page numbers here. I can't see that. Oh, 7, there we go. Okay.
It's basically the last two, yeah. This is actually what you're getting on your money in the long run. You can see current -1, current -2. Keep in mind, those aren't actual percentages. But if you keep going down.
Okay, and just to give people, okay, we'll go down to the bottom and then you want to give them a number.
This is the internal rate of return on your money.
So by 95, in this example, the internal rate of return, this is annually?
Yeah. 3.32%.
But that's current -2%. So
yeah.
Isn't the 95 really 5.28% or whatever this is?
Well, here's the thing. Based on the current dividend scale interest rate, it's 5.28%.
Okay.
Internal rate of return. But the problem is I'm not confident that that's going to be the case. They're not giving me any context by which I can believe them. I've never seen an illustration that's been accurate.
That's true. Mine. I think I'm 8 years into mine and mine is behind. Like,
yeah.
It's lower than the projection was.
Think about, and if you're lower now, it's only going to get worse. Like, it's not going to catch up. It may, but I personally believe that interest rates are going to go lower. Like, look at how much debt's out there. Either we keep pushing interest rates lower, or things collapse, and then it all goes to shit anyways. So, in my opinion, the true rate of return of these are going to definitely be under 5, right? So, what I wanted to do,
so they give you an internal rate of return.
Most people don't see this page. Remember, in order to produce, by the way, these are custom selections in the software.
Okay. So the internal rate of return on the death benefit here is coming up at 5.28. And then it's got this internal rate of return death benefit current -1. So that gives you what the number would be is if it underperformed the scale is by 1%.
By a factor of 1. It's not, I think it's yes, by 1%. But it doesn't necessarily mean like the fund is returning 1% less. It's not a number. So let's say if our predictions are off by the scale, a factor 1% lower, this is what the internal rate of return will look like by the age of 95.
Okay.
Which is 4.29, and then...
Which is a big difference, really, because that's a 20% difference, right? From 5 down to 4.
What about current -2?
Yeah. It gets
I can't illustrate lower than current -2. And I have clients making a third. I have a few policies, as I mentioned, with 0 dividends.
Okay.
Right? So how bad can it get? I don't know.
So this is what got you this is what got you going deeper, because you start looking at money without not even thinking about the insurance side of things for a second. So you just start thinking about the monetary value of these things and earning a return on your money. Because if we look at this, because then we got to bring inflation into the mix here too.
Yeah.
And if we look at this, and we look at I know what we're told inflation is, but if you look at the goods that really matter, inflation historically has not been in the 2% range that they try to tell us.
Right. Yeah.
It's been multiples higher. So typically, even if you're earning the 5% that they're saying here, you're likely underperforming inflation really
significantly. Yeah.
So that's something to consider. Different people will argue that different ways, because they're like, well, some people believe CPI is a very accurate metric. More and more people aren't believing that because they just look around.
Yeah, you can tell.
It's easy to see, right?
I'm sure you hear it all the time, like actual inflation. People know, right?
Yeah. Well, I mean, housing inflation's been well above 5%.
Yeah.
Food inflation's been well above 5%. A lot of things that are just, that matter more. And then our CPI, for anyone, like people, I think a lot of people know this. We've talked about this before. What they do is they just kind of replace the basket of goods. So if people are no longer buying steaks because of the cost, and they're buying ground beef or even lesser beyond that,
right,
then that's now the thing that gets plugged in there because it's at a cheaper cost, and it keeps CPI down.
Right.
But it's not really a fair representation of what's going on,
so,
right?
Yeah.
So it's no different than housing. Like if people used to live in a 2,000 square foot home, but now because the cost of that, the starter home is, and I'm just throwing things out there, but it's a 500 square foot condo. They're like, okay, well, roughly the housing increase isn't really that bad for housing for people. Well, like, no, it's very bad, because the cost might be the same on a monthly basis, but you're going from a 2,000 square foot home to a 500 square foot condo. Big difference.
Right. And one thing just to add, I have illustrations here from Manulife and Canada Life. They're all pretty much the same. The numbers look very similar. The premiums are similar. The death benefits are similar. All the products are extremely similar across the marketplace. And it's also, I think it's important to realize, especially for people who are in a high tax bracket, this $95,000, this is after tax money, right? So if it's in your corporation, you have to pay tax on that. And if it's personally, you have to pay tax on that money. So the whole idea, I get that it grows tax free, but you are losing a lot off the top just by contributing to this. And listen, if you are making boatloads of money and this is a bond component of your portfolio, then power to you. I'm not speaking to those people. I'm speaking to people who are sitting down with either infinite banking advisor or someone who's pitching immediate financing and is looking at that premium and is saying like, this seems like a lot, right? That's who I'm talking to, because it is. So what I wanted to do, and I was thinking about this in in context of your conversation with Jason, because he mentioned that, well, my dividends are $80,000 a month. And I feel like he mentioned that to you so you'd be impressed with it. And I think most people, if you're saying, well, I'm getting $1 million a year for my insurance policies, that is impressive. Mm-hmm. But the way I think about it, I'm like, well, hold on a second. Did you put in $5 million? Did you put in $10 million? Did you put in $1 billion? Because that matters.
Well, yeah,
right?
and that's actually what I didn't ask him to disclose the number, but we did stop there. We moved on with the conversation, and that's what I asked. I'm like, because it was stated as like, well, isn't that good? And I'm like, and to your point, I'm like, well, no, like it depends. Like
Well, yeah,
if
exactly.
if you put in 50 grand and you're getting 80 grand a month, you're the best investor ever. You know what I mean? But
Totally.
like you said, if you're putting $5 million, well, then maybe it's not as good as as some other opportunities, right?
I've been in meetings with some of these infinite banking guys, specifically talking to real estate investors, private lenders, that talk about how the returns inside these policies are better than second mortgages, right? It's so skewed. Now, I would argue it's safer investment than second mortgages, but like, let's be really clear.
The last couple of years.
But I have a few seconds. I wish I would have bought par. I tell you that right now, right? But at the end of the day, like, we need to be very specific about what these are and what these aren't. So when you had that conversation, I thought to myself, I'm like, I need to illustrate what's in my head.
Okay.
So what I did was I went on Fiverr and I found an accounting firm in India, and I've been working with a guy for about last 6 months to create effectively insurance type illustration software for myself, where I build in what I believe is the right way to show people the other side of the coin. And the results are pretty interesting. So let's pull up S&P, 95,600 a year per year at 10% for 20 years. Perfect.
Okay,
now, the next stage of this stuff is I need to produce these illustrations so they don't look like total crap, right? But effectively zoom in. And if you go to, the assumption here is clear, right? This investment would be in a total return index. So you are buying the S&P 500 in a fund, or through, specifically Horizons has one, where all the dividends that the S&P 500 issues just stay within the fund, so you're not actually paying any tax. Your tax is totally deferred to death, or till when you dispose of the fund.
So repeat that. How did you do that?
So I'm just assuming this. I'm saying if you're going to go down this path, and this assumes that you're buying something that the tax is totally deferred.
Okay.
So a lot of the insurance illustrations, the advisor would be like, well, your money grows every year, you have to pay tax on it. Like, you don't have to. You can invest your money where it's fully tax deferred until you either dispose of it, or whatever you want.
Yeah, but either way, I mean, yes, if even that component is still just, it's nice to just get a different perspective and have an understanding.
Yeah, totally.
Of stuff. So you're doing investment amount $95,000.
Yeah.
65 years, a return of 10%
a year,
and then the investment stops 20 years. So 95,000.
Same to the insurance policy, right? And matching the insurance.
And why are you using 10%?
Because over the long run, that's what the index
What's the long run?
65 years.
65 years. So,
in this example.
So over 65 years, you went back, because I think you did this, right?
Well, that's the next one. That's
okay.
The next
okay. So let's. Okay.
But a lot of people talk about how over your lifetime, the index on average will do 10% a year.
Okay. So.
And this is what I'm predicting, right? Here's the thing. I'm telling you what my prediction is, or what I'm hoping it's going to be. The insurance companies aren't going to share what their predictions are. And if you go to age 65...
And you actually have management fees in here too.
Yeah.
So you've taken in management fees.
Totally. And
this is on video, but remember, a lot of people are listening. So I just want so you just call out whatever points you want to call out here.
Basically, as your money grows, I have the management fee structure, right? And on the first $500,000, you're paying about 105%. And above $1 million, 95 basis points, above $2.5 million, 75 basis points, and above $5 million, 55 basis points. Okay. Now go out to year 65.
65, which is the end. That's
the end. That's age 100, effectively, similar to the life insurance policy.
Okay, and this is the total?
Your portfolio is $287 million, 10 times bigger than the death benefit of the life insurance policy. I don't give a crap if I'm paying tax on that.
Yeah, well, even if you pay a high tax rate, they're substantially higher.
Yeah, it's and then at the bottom, $215 million there. That's the net to the estate, assuming tax on 50% of the gains. So even after tax, you're like wildly ahead. Now, is this to say you shouldn't do life insurance at all? No, I'm just saying it's not an investment. It's not a high growth product. It's not some wealth hack. And if wealthy people are being compelled to do this, then I would argue wealthy people are being lied to, when the product's being misrepresented, to just reinforce the existence of these products as a whole. Insurance companies in Canada have $300 billion in par assets under management. Universal life assets are 10 to 15 billion in assets under management. And the reason is because there's a massive incentive to sell these products. If I bought this par policy for $95,600 a year, right? I am going, and it's a high cash value product, my commissions are $80,000 up front. But if I convince you to put $100,000 a year into the Horizons total return index, What, I'm lucky if I'm making $900 in the first year? Now, I'm not saying that advisors only think with their income. That's not what I'm trying to say. What I am saying is that the incentive structure matters. And when you incentivize people this much to sell these types of products, of course they're going to become so prevalent. Now,
I want to come back to this 10%. You've covered a lot. I just want to come back to the 10% because I'm sure some people, like myself, is like 10% is like, that's high. So I just plugged in really quickly the average yearly return for the S&P 500 over the last 50 years. So this is what's coming up off Google. It looks like it's a trade. One of the top search results coming up with the average yearly return is 11.621% over the last 50 years as of the end of May 2025.
I'm being pretty conservative then.
This assumes dividends are reinvested.
Yeah.
Adjusted for inflation, the 50-year average stock market return, including dividends, is 7.68%. So yeah, we're not adjusting for inflation, but yeah. So it seems like you're, based on this, you're kind of you're in line.
Yeah. Now here's the thing though. You can say.
So and then sorry, your point before was you're just saying so like. What's not being disclosed? Are the commissions disclosed to people when you buy an insurance policy?
So they're supposed to be, but they
weren't to me. Like I never knew what the commission.
These are custom pages. You have to like select the commissions.
So there's no
select the internal rate of
return. So there's no requirement. Like in real estate, we have to. People have to sign off on like, yes, you're earning this much commission.
Yeah.
Like everyone's earning this much commission. But in insurance, it seems like that's not the case.
No.
Because I'm sure that would make people question things. Because
Right.
if someone's all of a sudden selling me a policy, I'm like, oh, you're going to make 80 grand off this? There's definitely it's a large incentive for that person to push me in one direction. I'm not saying anyone has done this or that people do. Well, I mean, let's be honest. In every industry, people do that, right?
I don't care what you're doing.
But yeah, that's across the board. That's nothing. That's just humans, unfortunately, right? But it allows you. I've always liked to be sold to like, just give me all the data and then let me make my decision versus just giving me the data on where the direction you want me to go. That's always frustrating.
Can I touch on the commission thing for a second?
Yeah.
So I'm trying to earn some business from a family. And I know for a fact I'm in competition with the other advisor on this. And I've had these discussions with the son that I'm working with specifically right now. And I'm producing options that I believe are significantly better, orders of magnitude better, whether it's investing or insurance, a little bit of both. And I mentioned how the commissions are much higher with PAR than with UL. The compensation, sorry. I meant compensation, but I think it said commissions. So what does he do? He sends an email to the other guy, and the other guy says, well, no, the commission on a UL is 60%, where on a PAR it's 50%. So that's the base premium, though, right? On a UL, I am paid fine at 60% off the 600,
off of the half amount.
But for PAR, I'm paid 50% on the 1200, right? Not to mention I'm bonused as well. So for UL, how it works is, let's say someone's making, I sell a policy for, I'll tell you how people I get paid, 100 a month times 12, 1200 a year times, let's say 50%, 600 is a first year commission, FYC. I'm bonused 185 plus 600, which means around 1710, just a little bit more than the first year's premium, right? If the base premium of PAR is twice as high as the base premium of UL, even though the first year commission is a little bit lower, it's twice as much premium.
It does seem a little bit disingenuous to respond to that with a percentage amount.
I know.
Most people are probably looking at the dollar amount.
So what I did was I produced an illustration for this guy, basically saying, okay, 200 a month into PAR, 200 a month into UL, right? The UL was structured where 100 a month cost of insurance, 100 a month investment contribution. The PAR was 200 a month all base premium, and the PAR would have paid me 50% more. That's significant. Like the incentive structure really does matter.
So your whole argument on this, and maybe that isn't the whole argument, and I know there's other spreadsheets that you went down to, because it gets very interesting when you start looking at the actual numbers behind this. But your position, and correct me if I'm wrong, I'm trying to kind of speak this out in my head, is that, you're leaving by giving the additional funds into one of the PAR policies and going for that, 5-6% return that they're offering that isn't guaranteed, but that's what they predict.
And let's assume you get it for a second.
Sure. Okay. And nothing's guaranteed. There's no guarantee in the stock market. We can go back to,
I disagree, but
yeah. But anyways, you're saying that you just leave a lot of money on the table because otherwise...
Not just a lot, like ridiculous, life-changing family wealth money on the table.
Okay, that's a different way to say it.
Like, it's not just like a little bit more.
Yeah, no, I get it. But then, because with the universal, which is that's your preferred product. No.
Like, I like universal life insurance because there's some transparency there.
Okay, but hold on. The reason I'm going to say this, because I just want to finish for anyone listening. Because the universal, you're saying, well, you pay this much for the premium, and then the investment component, then you can put into whatever the funds they have, and thinking that the funds will mimic the index, and then you have some control over those funds and those choices, and then you can likely earn more even on the insurance side of things.
Yeah.
Never mind outside of the policy or anything like that.
Yeah.
Okay.
But I don't want people to do too much of that either. If you have a bunch of extra cash in your corp and you like the idea of having some permanent insurance, as a matter of principle, I think you should buy UL. As a matter of principle, just because if you email the insurance company and you say, hey, the 5% dividend scale interest rate, what is that based on? And they say to you, well, you're on a need-to-know basis. You shouldn't buy it. Just buy something you can decide what to invest in. If you're like a conservative investor, fine, buy a UL and put your money into a bond fund. Buy a UL and put your money in GIA. If you like the index, buy the UL and put your money into the index. But don't buy something where they tell you you're on a need-to-know basis and our predictions are proprietary, they're private, we're not telling you. And as a matter of principle, we should not reinforce the existence of a product like that, especially when there's a massive delta between what the way the insurance companies pitch and talk about the product and way individual advisors pitch and talk about the product. There's a massive spread there.
Okay.
Now, I just want to go back to these illustrations for a second, because
which one? The same one?
Let's go look at the same one. I was speaking
because the argument's going to be about borrowing against it.
Let's get to that next, right?
Okay.
Let's get to that next. But when I was speaking to a gentleman who recently retired from Canada Life, I was talking to him about this stuff. I mentioned the 10% a year, and he's like, "Oh, Adam, that's the Monte Carlo." I'm like, "What are you talking about, the Monte Carlo?" And he's like, "Well, you're just assuming that this is going to spit out 10% a year no matter what in all years. That's like the ideal scenario. That's not going to happen." He's like, "The index is volatile."
Which is right.
Which I'm like, shit, that's a good point.
Yeah.
Right? And that's why I like talking to because every time I talk to someone who gives me perspective, I'm like, I need to do something about it.
And I want to give you credit for that, because I know you've had a lot of conversations with people selling the par policies who strongly believe in them and stuff.
Yeah.
And you're not trying to argue with them. You're trying to understand.
I'm doing both, but yeah.
Yeah. Well, that just seems to be a little bit like who you are.
Yeah, I know.
But it's more. But you're also trying to learn. So like you'll naturally argue. Like it's kind of similar to the way I do things sometimes. Like I will naturally I want to position the opposing view because I want to understand how the opposing view is wrong, so potentially I can learn.
Yeah.
So it's not just, I'm not arguing because I'm trying to say I'm right. I'm trying to explain what I'm thinking. And if someone can explain to me how my thinking is incorrect, that actually makes me happy. I'm like, oh, like you just said, you're like, oh, good point.
So I
never
saw
thought
this.
about that.
I'm like, shit. I thought I was like, oh my God, people are getting scammed. They're leaving so much more money on the table. Then he says, well, the index is volatile. I'm like, first of all, I'm like, how could I not have thought of that? I'm like, you idiot. And secondly, I'm like, shit, what if it's actually the par is better now? What if I'm wrong? Yeah. Like, what if the index is so volatile that people aren't that far ahead? And I just, had these conversations with these angry advisors, and like, what if I'm the idiot now? So I go back to that guy and I basically get the history, the annual returns average every year dating back to, what year did I go back to here in my modeling? I went back to 1950. So now, go to the next illustration if you don't mind. Do 95,600 per year, back test S&P from 1959. And zoom in and go to age 65. So year 65. It actually looks better. $352 million. So
let me just share it on the screen. Hold on.
Yeah, totally.
Okay, there we go.
$352 million. So if I'm doing two things here. First, I'm saying I am making a prediction, or I'm assuming that you can get 10% on your money a year between now and your age of 100. and you'll have in the order of $250 something million.
And so this is with accurate.
This is annual S&P returns, inclusive of management fees, right? If you would have started and putting 95,600 into the S&P starting in 1959, you stop putting the 95,600 in every year after 20 years, and you let that sit till age of 100, and you died in 2023 at the age of 100, your portfolio would be worth $352 million.
Okay.
And the net to your estate after taxes and whatnot would be $264 million.
Okay. And I see it here, 12% in, the first year, 0.5%, it's 26%, negative 8.7%, 22, 16.5, negative 10, negative 8.5, 4, 14, 19, negative 14, negative 26. So yeah, okay.
Yeah, the 74, Black Monday. Right?
Yeah. Okay. So it actually ends up being these returns are slightly better.
Yeah.
Which makes sense based on the number that we looked up.
There you go. Yeah.
Slightly better than the 10% that you had.
Mm-hmm.
Okay. Mm-hmm. 2008, negative 37%.
There you go.
So then, okay. But there's an argument to be made if you need the money.
Yeah.
But I guess that argument kind of exists with the par policy too, because if you're putting in money and you need it in the short term, you can't actually get all your money back.
No, you're getting crap back.
You can only borrow.
Listen, my point with all this, and this is why I use the life insurance.
Well, when I mean you can't get your money back, I mean the borrow against it, because depending on the way things are structured, sometimes you can borrow like just a tiny amount. Like I know the way mine's structured is more for insurance on the back end, so the upfront cash value is kind of small.
You can buy policies where you can get effectively 90% of the premium back in the first year.
But then you sacrifice the insurance.
Long-term gains.
Right. Yeah.
But compared to the other type of insurance policy, if you compare it to the index, you're sacrificing a lifetime of money.
Yeah.
Now, advisors will say, or some will, well, like the index is volatile. Imagine the stock market drops 40% and you need the money. And I'm like, I don't care. Okay, fine. I had, what did you have in 2008 in this example here? Oh crap. My 92 million turned into 60 million. Okay, so it turned into $60 million. Right. But here's the thing. I'm not telling people that you should therefore take $100,000 a year and put it in the index and use that as your estate plan. Like, I don't know what you should do with your money, nor do I care what you should do with your money. All I'm saying is this insurance policy is not a good place for it. It's just not, right? And the only reason why it's so popular is because the industry is massively incentivized to offer it. That's it.
So then, then sometimes do people then look at this and think, well, shouldn't I just get like a term policy and then do something like that? I guess, like you said, it's going to be, it doesn't matter. There's going to be something for everyone.
Yeah, but realize with term, your money's down the drain. Like there's no perfect product. I'm product agnostic here, right? Like sometimes people say, well, you're doing this because you're just pitching this other thing. Yeah, like I don't care. Like don't buy any of it, right? For all I care. This is after 15 years in the business. This is how I think about these products. And if you say you want this, I'm going to tell you the bad. If you say you want this, I'm going to tell you the bad.
The good and the bad.
Both the good and the bad.
Yeah.
Listen, my compulsion is to talk about the bad, just because I don't think we talk about the downside enough.
We got to give you some sunshine, man.
Yeah.
We got to give you some sunshine.
I've been burned a lot recently, man.
Some sunshine and hugs.
There
okay?
you go. I need hugs, right? So I've been burned a lot recently.
I think maybe I have some old Care Bears in there.
Okay,
so I'll give you some Care Bears you can take home and cut
I love Squishmallows.
That's the new version. Yeah. Care Bears. I'm an old guy. I'm thinking Care Bears still.
So I think we can both acknowledge now that, insurance companies talk about, we talk about the dividend scale interest rate to illustrate, what changes in the scale do to your money over time. I'm like, okay, I'm doing this to illustrate how much money you are leaving on the table potentially for your family by diverting too much of your capital into these products and structures. So that's just par life insurance on its own. Let's go to the next layer of infinite banking specifically. The whole idea behind the infinite banking is that it's not about the death benefit. I think Jason said on the podcast, a lot of my wealthy clients, they have no need for the death benefit, right? That's not why they're doing it. It's about controlling your capital because when your money...
they can borrow back against it.
When your money is in their bank, they control the money. And this is your bank. Now, that's just not true. You don't have control over anything. Unless you hold Bitcoin on your own wallet, you're not in control.
Yeah,
no matter what. I don't know what else to tell you.
Yeah,
Whether
I agree.
You're not in control if your money's in the index. You're not in control if your money is in your house, no one is in control of anything. We are all doing our best to operate with as much control as we can, and the banks just have us all by the balls. That's just what it is.
I agree with that. There was always an image that stuck out. It was from a Kiyosaki, and I think it was Why We Want You to Be Rich. It was Robert Kiyosaki and Donald Trump co-authored a book. Probably neither one of them authored it. It was probably ghostwritten, but they just put their names on it anyways. But anyways, it was like, this is years ago, decades ago. And there was always this image that I always remember, was risk equals and then control with like the no smoking sign kind of over it. So no control. And as soon as I've always believed that as soon as you hand over your money to someone else, whether it's a bank, insurance company, whether I give money to you, whatever, it's my money is not as safe as it was then when I was controlling it.
And like you're giving up that control for a return.
Yeah, and that's how you earn return.
You make money.
That's because there's a risk involved to that.
100%.
I'm giving up control. That's the risk, and I earn return because of that.
And this is very low risk. It's almost so low risk that you are losing out. But it goes one level deeper, right, than the control. Insurance companies, when they invest your money, they do it for your benefit because you are an equity holder, a part owner of the insurance company. Okay. So when you pay them and when you borrow from it and you pay them interest, that interest is coming back to you. And therefore, you should borrow from this policy to finance the things throughout your life, right? Because rather than the interest that you're paying to CIBC or the car financing company, right, why not use a policy loan to pay for what you need? And when you're paying interest into the PAR account, that interest is coming back to you as a dividend. And the reason why you should invest in the insurance company is because they're an amazing investor. They've always turned a profit. They've calculated things to win. Well, Loblaws calculates things to win, right? When they put something on a shelf that they bought for $1 and they sell it for $1.20, right? Just because they've structured, all businesses are structured to make money. You know, Coca-Cola has paid out a dividend every year for the last 100 years. Just because that's the case doesn't necessarily mean I should therefore buy Coke because they're putting their money to work or accordingly. Or even if you want to buy some Coke, it's not to put all your money into Coca-Cola stock because, you know, 100%.
Because of that. Like, hey,
at the end of the day, what matters is what you're making, right? I don't care what they're doing. Listen, when I say I don't care what they're doing is, let's assume it's a legit investment. It's blue chip, right? There's a lot of transparency and disclosures around what they're doing. What's in it for me? And that's the argument that I'm making. There's not nearly as much in it for you as you think. So people, because of this idea of control and earning interest and being the bank, because of that rhetoric, they're being compelled to put a lot more money into these policies than they should. And because they think they're getting 6% of their money, why not put in $100,000 a year, borrow back all of it immediately at 5%, and I'm making a free 1% for the rest of my life. What they don't realize is that they're buying something, right, that they're paying more on the debt than they're actually making in returns. It doesn't make any sense. You're actually much better off mimicking the infinite banking structure, but just using the index. You can put $100,000 into the index and borrow back $75,000 immediately. If you look at the bottom, go back to the early years of debt servicing. No, don't do debt servicing. Do 95,000 a year, 10%. 95,000 a year. 10%.
Oh, this one.
Yeah, exactly. Go to the first few.
Is this? Are you have borrowing back against it?
Go.
A lot of people don't think you can borrow on this stuff.
Yeah, you can.
And you mentioned it earlier with Duca Financial. Actually, will give you.
It's great. Go low.
Yeah, I'm just trying to zoom in. Give me a second here. Doesn't seem to want to zoom in for me here today.
Either way, the first column shows you 95,600. So what you can do with Duca, you need an advisor to do this, right? I wouldn't be surprised if eventually you'll be able to do this through Wealthsimple or Questrade, which will be interesting. But you put $100,000 into the index or whatever portfolio you want to. You go to Duca, and Duca will give you a line of credit, anywhere between 50 to 75%, whatever you can qualify for, against the fair market value of your investment. A lot of wealthy business owners will buy these policies independent of infinite banking for financing arrangements. They're called IFAs, immediate financing arrangements. So you put in $100,000 a year, the cash value is $90,000, and you borrow back 80 or 90 right away. Why do you do that? When you're borrowing against something, it creates a deduction, interest purposes. Now you can write off your insurance premiums. My argument is, if you want to finance anything, if you want to have money grow in your business and still have that capital available to you, just put the money in a portfolio and buy back 75 cents on the dollar. Sorry, borrow back 75 cents on the dollar immediately.
But then you have to pay payments on that.
Yeah, pay interest on it.
And
No different than infinite banking. No different. You put in 100,000 a year, you borrow back 90 to finance a car or to finance a down payment on a house or to make another investment in the stock market. You borrow, you pay the interest. I'm just saying, you might as well, if you're going to do this, you might as well borrow against something that's going to give you 10% a year rather than borrow against something that's going to give you 3-4%.
In your illustrations here, did you work in all those payments and things like that, or no?
Well, no, because this just tells you that you have access to 50 to 75% of the capital of the fair market value at any time.
I guess it doesn't make sense. So there's no, you're basing it just the equivalent to what the premium payment would be, not borrowing against it to get that leverage or whatever. Because then you're comparing apples to oranges.
Yeah.
Because basically those
Totally.
policies are sold with just the premium. Here's the return on that. That makes sense.
Hardcore infinite banking guys would be like, look, here's your fund to use for leverage, right? Here's your cash value.
Yeah.
You can borrow against it at any time to fund whatever the hell you want. We think you should use this to buy a car because when you borrow against the policy and you pay interest to your policy, you're making the interest. It's bullshit, but fine. Okay, so if you want a line of credit, if you want money invested that you could have access to at any time without disposing your interest in the asset because the asset's going to continue to appreciate in value, buy the index.
It does, when you put the numbers together like this, it's hard to argue them, I guess. I mean, I'm sure this is why, and I'm not saying you're wrong, but this is why I'm disappointed that someone that is that has an opposing view to you is not willing to come on and just be like, hey, let's discuss this openly, not argue. I don't want to argue about this. I'm like, hey, I just want, because
it always goes there.
It's nice to have the opposing view side by side.
It always goes there.
Because I know people are going to reach out to us and be like, well, guys, you know what? You guys didn't talk about this, this, and this. And I'm saying openly now, yeah, I'm not the flipping insurance expert, but I've been asking someone else to come on. And they're like, no.
I don't even think I am sometimes.
And
I'm just after it.
And I'm glad Jason came on and discussed infinite banking the way he sees it and stuff as well. Like that was good. And I appreciate that. And it was a good conversation. And it's great. I just wish that people would be willing to do it,
I wanted to full disclosure here. I wanted to do this with him and he wasn't willing to, and that's fine. And I've wanted to do this. I don't want to single him out, but I've wanted to do this with a few other people who are very, relatively speaking, popular in this space, and they don't want to do it. There was one gentleman who advertises a lot online. I reached out to him, and he was interested in doing it, and he wanted to have a conversation with me first. So we got on a first call, and it's very nice and pleasant. It's hard for me to really dig on these calls with people, just because everyone's trying to make a living here and everyone has their own perspective and philosophy. So we had a good initial call, and he said, before we do a recording, I want to take you through my presentation. I'm like, sure. So we do a Zoom, and
were you friends at the end or no?
No. So we do a Zoom, and everything's fine. The first 2/3 of the presentation is all hyperbole. You have no control, paying all this tax. When you buy something and you finance it through a bank, they make the interest, you don't. You need access to capital whenever you want. And listen, one thing I can say is, with this sort of stuff that I'm pitching, you do need to qualify with Duca, whereas if you have an insurance policy, you don't need to qualify with anyone. That's the one thing I can understand. You don't need to ask anyone for approval for a loan. Fine, I still think it's dog shit and not worth it, but nonetheless, I'm willing to admit that is some one piece that I kind of get, even though I think it's BS. But things took a turn for the worse when he took me to a slide. He had a client of his that has been putting $5,000 a year into this par policy dating back to 95. And he had this chart, and it was grayed out. 2 columns were grayed out, and the returns were pretty amazing. And he says, Adam, the returns of this par policy are better than these 2 investments. What do you think those investments are? I'm like, I don't know, man. What were the investments? And he goes, Berkshire Hathaway and Bitcoin, right? There's a ding. Did something happen?
No, I think
cool.
We're good. I'm not sure.
Cool.
Yeah.
I thought maybe I kicked something. Berkshire Hathaway
and Bitcoin.
And
from 95.
And I'm like, it's not humanly possible, right?
Yeah,
and we started going back and forth via email, right? And I gave him the numbers. I'm like, if this person would have put money in Berkshire Hathaway in 1995, they would have this much. If they just would have bought in Bitcoin 1 year's premium of Bitcoin when it was available, they'd have billions of dollars. And then when I mentioned this to him in the context of the returns, he's like, well, Adam, it's not about the numbers, right? And I'm like, I didn't bring up the numbers. You're the one that brought up the numbers. You're the one that said, and he specifically said this, why would I invest in the stock market if I can get the same level of returns in a par policy without the volatility? And I agree with you. If that's true, fine, but it's not true. And then suddenly when I pivot and I'm like, your numbers don't make sense, right? He's like, well, it's not about the numbers. It's not always about the numbers. And I'm like, you brought up the numbers. And that's when it took a turn for the worse. And he's not willing to do a recording with me. That's fine.
Because when you look at these numbers, and we looked at the ones from some insurance policies, like the projections, and we looked at these numbers going back through time, taking the numbers through time, and there's nothing guaranteed in the future on both. But it's hard to say that the numbers are comparable. It really is. You had this one other one. It says backtest S&P 500 from 1959 debt. What's that?
So as I started going down this road, I thought to myself, I think I've come up with the most superior passive financial product in financial services. So
Whoa,
I'm going to make
a big statement.
I think that if everybody doing infinite banking or immediate financing, right, if they can afford that money.
What's immediate financing? That's another name for infinite banking?
It's the pure form of infinite banking where rather than selling people bullshit on what the par fund is for them, you are buying the policy and borrowing it against it.
Okay.
Just borrowing against it immediately. So the problem, let's say you are in the 50% tax bracket, okay? And you're investing passively through your corporation, $95,600 a year. You're paying 50%, 50 points on your money every year. You actually have to earn $191,000 a year to net $95,600.
Got it. Okay.
Right? Taxes. However, interest is tax deductible. So if you can afford $95,600 a year, divide that by current interest rates, 5%, $1.9 million. You borrow $1.9 million, you're paying interest of $95,600 a year.
Oh, got it.
That interest is tax deductible. The net cost is actually half, which is, I have it in there somewhere. I'm going to pull this up. Give me a second here. Oh, that's going back. No, that's the wrong one. Back test, S&P. Service debt, $95,600 service debt at 10%. Go to that one. So you'll notice you're paying the $95,000 6-month interest expense is around $90,000 a year. The tax saving is $43,000. You're only out of pocket half that, assuming you're in the 50% tax bracket, right?
Yeah, here's interest expense.
Exactly. Right. Now people will say to me, "Well, hold on a second, Adam. Where am I going to get $1.9 million from?" You get it from Duca. Divide that by 4, $478,000. If you have access to your own home equity line of credit. Let me be clear. You have to afford the $95,600 a year.
Yeah. This is an extreme example.
This is an extreme example, but you can use these with smaller numbers, right? Yeah. I'm working with someone who's doing this soon. You take a $500,000 line. I think he has a $2 million line of credit. And he's like, well, why don't I just put my whole $2 million in? And I'm like, why would you exhaust your line of credit when you can take a $500,000 out of your line, go to Duca, lever it up 3-to-1, and have that $2 million invested, but you still have $1.5 million in room on your line of credit in case shit happens or in case you want to collapse it. So the idea is you lever it up, you carry the interest, you get half those interest payments back every year. In year 20, this collapses. So if we go to year 20 now. No, so you're in the wrong one. Go to debt servicing, the debt service. You can go to this illustration. You can keep it here, basically. Go to year 20. And then in year 20, what you do is you collapse the portfolio. You collapse $1.4 million of the portfolio to get rid of the debt. Because similar to 20 pay with a life insurance policy, with a Equitable Life or Manulife or Canada Life 20 pay par, in 20 years the payment stop. Well, in year 20, the payments stop here as well. Why? Because you're collapsing the debt and you let the portfolio ride. Over those 20 years, rather than paying $95,000 a year in after-tax premium, you're paying $95,000 a year in interest, which only cost you $43,000 a year. So your net outlay is half. And if you go to your age 65, age 100, $400 million. You're even further ahead by using debt. And remember, you're only outlaying half the amount of capital.
Yeah, well, you're using leverage. I mean, look, I just want to be clear, just to anyone.
This is wild, by the way.
Yeah, it's totally wild. And there's like, you got to carry that. So you have, if you have income disruption or mortgage or.
Well, you can also collapse it if you want. But then what if you collapsed it when like the market crashed? Listen, this is.
It's fun. No, it's fun as a thought experiment.
That's
and
exactly
maybe some people want to go down this path. It's just, it's not appropriate for probably the large majority of people, right? So.
But the irony is, though, why is this inappropriate for the large majority of people, but the 20 pay par is?
To me, it's the leverage. I don't think everyone can handle.
They're doing
leverage.
it. I went to my annual insurance event. Advisors,
You must be a real rock star.
Oh, yeah, tell me about it. I shut up a lot. I just don't want to.
So you just hide in the corner? Do you hide in the corner?
Yeah.
Do you go with a bodyguard?
I remember I went to this. I went to dinner with a few guys. You meet these random advisors, and we were at the table, and they were like, "Oh, what do you focus on?" I'm like, I don't want to get into it. I really don't, right? Because it never ends up well. And one of these guys, he was like, "Oh, I do complicated stuff," and I'm like, "Oh," he's like, "Oh yeah, all financing," and I'm like, I just didn't want to get into it, but. Later on in the event, there was this gentleman, and he's doing like $20 million a year in premium, and it's a lot. It's a lot.
Okay.
Right? I don't know if I'll ever do that in my lifetime in this business, based on how I sell, and I get these clients with the way I advertise. Like I know it's all debt, the way this is structured. If you would try to do this with Duca, in the terms of the debt for leverage, the amount of compliance you would have to go through on the security side to qualify for, even if Duca's like, I'm going to give you the money, even if Duca says that, the amount of, I'm working with this guy, Jeff, at Design Securities, to help me with these clients. I refer them over. I'm not going to do them on my own. He manages money. The amount of compliance he has to go through to make sure that this is the right type of setup for this client is wild. Meanwhile, I have an advisor can sell you a $100,000 policy with no back office approval.
$100,000 premium a year. Yeah, okay.
And send you to Duca for you to finance it back out. And there's no one back there saying, is this right for Nick? Now, I would argue that maybe that shouldn't exist. Like maybe whose business it is, the people at the securities back office, whether or not this is right for you. Like you're an independent thinker.
Yeah, but if it's being done in one place and not the other.
Well, yeah, that's
yeah.
And not to mention the place it's not being done, you're compensated 1,000 times more than the place that it is being done. There's all these imbalances in the financial services industry, specifically in the context of life insurance, that no one's talking about. And the amount of not only real estate investors I'm meeting, but dentists and doctors who are putting so much goddamn money into these contracts, thinking they're good investments. They're leaving lifetimes of money on the table. I'm working with a doctor right now. He rents his house, have a few kids, broken down marriage, building back up, maybe $1 million in an investment portfolio. He's putting $250,000 a year into par. I'm reviewing 4 policies of his. He's working too much. He wants to retire early. If he would have just had 4 less par policies than the 6 he has, and would have just put that money into the index and not had any advice, he'd have $5 million today and he'd probably be able to be retired. Meanwhile, he's still got to feed these things, and he rents his home and has $1 million portfolio. You're putting $250,000 a year into par. Like,
yeah, the $250,000
come on, man.
Seems,
it's wild. And that's my problem. Listen, I have problems with the insurance companies, the way they talk about them. I have problems with the advisors, the way they talk about them. I have so many problems. It gets even worse. It gets even worse when I'm dealing. It gets even worse when I meet people one-on-one, right? And I'm seeing the way they're sold. When I'm talking with you as an advisor about these things, you're going to say the right things to me. Bond component of a portfolio, high net worth individuals. It's not right for everyone, but it's right for the right people. There's estate advantages. Fine, right? Show me Jim. Show me how much money Jim has. Like, what is Jim buying?
Yeah.
And I've never met a Jim that I'm like, this was objectively speaking the right thing to do. The reason I get so angry about this is because I've done very well in some investments and I've done completely shit on other investments. I know what it's like to make 10x. I know what it's like to lose all of it. I want to make money and I want to help people make money. And when I see people being sold something that is a scam, what I mean scam is a massive delta between what they think they're going to get and what they're actually going to get, and the amount of money that they're leaving on the table. via getting advice, it hurts me. And so much opportunity is being lost because we're taking advice from the wrong people. And we don't know how incentivized they are to offer these structures. And it's a big problem.
Yeah, I think it's really important when you can see. I don't know. There's very, I don't know why. Maybe they don't want to. Maybe they're choosing not to for a specific reason. Whatever it is. But there's a lot of very few people that will speak the way you will about the positives and negatives of both and give you the complete picture. And I think maybe that's a bit of a problem. My belief is always that I believe there's positives and negatives to everything. And whenever I'm being sold something, it's just, there's always an answer and it's always a positive answer. There's like no downside to something. It always gets my back up a little bit because I just look at real estate investing. First of all, so that's our business. Obviously, there's some people, they should not be investors, like real estate investors. They're just not ideal people for it. Maybe they can grow into that person. Maybe that forces them to do it because you got to be resourceful. There's problems that come up. You got to handle it.
Think on your feet.
Yeah. And there's different.
You can't call your lawyer every time there's a problem.
Yeah. And if you have a 15-unit building versus one single family home, there's vastly different things. So there's different responsibilities and different work involved to, you have to, or the manager or different kind of cash resources you might need as a pool of funds. There's just differences.
Yeah.
And one might be the best. Someone might love apartment building and only want that. And someone's like, I want nothing to do with that. I just give me some single family stuff. It doesn't mean one's right or wrong and one's better or worse, but they've made that decision to themselves knowing what they know. And I think when I went through this process and when the conversations that I'm having, there's just far too many people that are like, well, no, this is just all good. And that's what I struggle with personally, because I don't believe that anything is perfect. There's no such thing. There's always like upside and downside.
Yeah.
So, I just think it's cool that you can have these conversations. I really do. And I know
I'm trying to have more of them, but
I know they're not
increasingly hard.
Yeah. And I know they're not perceived well. And it's too bad because I think we should probably open the book a little bit more and be a little bit more transparent and be like, yeah, guys, okay. So you know what? Yeah, there is this downside. Even though I'm selling this and I'm selling it and I make a living and I might earn a commission by selling this policy, this is the downside. But here's the upside, because maybe for the right person or the right place, there is something there. I know for ours, I think there's like a big contribution to the capital dividend account afterwards. Is that like an estate planning thing?
So if you look at the insurance illustration, right? There's we can just talk about this. We remember the numbers. Let's say you die at 100, you have this policy in a corporation. There's a $30 million credit your capital dividend account. The CDA is a notional account which tracks the tax-free portion of capital gains for corporations. So when you have a personal capital gain, half of it is added to your income, half of it's tax-free. You don't need to track that because half the money is tax-free.
Yeah.
So the capital dividend account is so corporations can track the tax-free portion of capital gains. A life insurance policy, generally speaking, it's just what's above the cost base. But let's assume for a second that you died at 100 with that $30 million policy. $30 million would come into the corporation, and you would have pretty much a $30 million credit to your capital dividend account.
Meaning it can be taken out by the estate
tax-free, exactly, or the spouse or whoever it is.
So for an estate plan, that's
the thing. So let's
but you're still leaving all the money on the table.
But let's go here. Let's say you did my example with $95,600 a year, 10%. Well, of that you have what do I have here? You have a $285 million capital gain.
Got it.
Which means you have a $140 million credit to your CDA.
Yeah.
Right? Like anytime an insurance advisor uses the word CDA, generally speaking, they're only talking about life insurance. Mm-hmm. They should be talking about real estate. Same idea, credit to the CDA. You buy the index, you dispose of it, credit to the CDA. You buy a stock, dispose of it, credit to the CDA. Just because there's a credit to the CDA doesn't mean that therefore the insurance policy is the right way to create those credits to your CDA. And a lot of people will tell me when I take them down this path of using some leverage, because that's my goal now. Anytime I talk to someone who has access to capital, who is in a higher tax bracket, you owe it to yourself to use some leverage, right? Fine. Don't borrow $500,000 levered up to $2 million, but do start with 50, right? Even borrow 50 off your line of credit and buy the index, because you can write off the 250 month payments, right, against your income. And now you have 50,000 invested rather than dollar costing averaging 250 a month into the market. Start small. But people are like, well, Adam, how do you make money? I'm like, well, when that guy borrows $2 million to to leverage into an investment. And I, just for like compliance purposes, I do this with an advisor who's licensed to do this. I say, listen, if you're going to take on $2 million in debt, buy a $2 million term 20.
Yeah, then it covers that just in case, right?
There you go. There's the high internal rate of return over the first 20 years. If something happens to you, the debt's wiped. And in the long run, you got the portfolio.
Yeah, it's funny. We're looking at the same thing, and we've just started talking. We just to make life easier. We call it the Breeze strategy. So Bitcoin and real estate kind of working together.
Yeah,
and we were looking at just some of the numbers on one of the properties. We're like, perfect. So let's do this. We'll do the experiment. And we took money on the line. The cash flow from that property covers the payment on the line.
Yeah.
We took that money, threw it into Bitcoin, and we're like, let's see what happens over the next 2, 3, 5 years, and where that offsets it.
I'd say take 20 years, right? That's the time
Sure,
frame you want to look at.
Sure, whatever. We're long-term investors. We're pretty open to that. So yeah, that's how we're looking at it. And we're like, well, the actual downside. So let's look at it over 20 years. We're like, well. And to your illustration of the market and historic returns, same with real estate, right? It's average is around here. It's average about 7% compounded from 69. And so then we're like, well, the downside's really like, well, if the real estate's very likely over 20 years to appreciate based on historic returns, probably similar numbers, maybe through inflation and money printing might actually grow and go faster like it has over the last 5 and 10 years. But let's kind of look at that. And the downside's really, well, the house kind of increase in equity covers the line anyways if we need it to down the road. So then we're like, the downside is not too bad. Let's ride it. And that's how we're trying to leverage some assets into the other. And there's nothing in it for us. And we're talking to clients about this. If they choose to go down that path, Bitcoin's volatile. Maybe it doesn't, you go in eyes wide open. Hey, maybe it turns to zero. I don't personally think it's going to happen, but whatever.
There's other ways to do it though, right? You can have that line of credit and drip into Bitcoin every month
that's the
without
other
going
way.
all in.
That's the other way.
So many ways to go about it.
You can just take the cash flow component and throw it in every month and do it as a savings vehicle.
Right.
Yeah. So,
or whatever the net cash flow is, just take that debt out.
Yeah.
So,
and we have a calculator that we kind of like very simplistic compared to the spreadsheets you put together because you have way more variables. We're just doing a couple of things, and for anyone listening, it's just at rockstarinnercircle.com/breeze, BREAS, and they can go play with that. And it kind of gets interesting.
Yeah.
So like you were doing here, just as a thought experiment, you're like, what happens if do this? And we can change the annual compound growth rates of the real estate and the Bitcoin.
Right.
And you can change that.
By the way, with one of the models that I have, debt back test to S&P, that also mimics the interest rate environment in that year.
Oh, really?
Yeah.
See, that's what I like about what you did, because it wasn't just like, I really think this is how it works and people should look at you. Got all the numbers and you put them together. It gets really interesting.
Yeah, it's taken a long time. It's been quite the experience because I didn't know what I wanted, but I knew what I wanted next. So I sent him a message. I'm like, hey, do this. And he does, and he sends it back. And I'm like, okay, now do this.
Yeah. You see what you want.
Now do this. Now do this.
Yeah.
And then you talk to someone and you're like, well, have you thought of this? I'm like, no, damn it. I didn't think of that. Right. And then that same guy that I spoke with, an insurance company guy, when I build in the S&P and I'm like, oh my God, look at the debt. Look how terrible these policies are. He's like, Adam, 5%. What are you talking about? Interest rates in the 70s were like in the teens. I'm like, damn it. You're right. Like, I got to go back and get the interest rate environment at that time. I took average each year, right? It changes quarterly. Like, you can only do so much, right? I'm trying to get as close as I can to the truth. But I think there is, in the same way you have an army of advisors who are selling these policies par, I think they're selling crap and dog shit. I think there needs to be a push to helping your clients utilize a smart amount of leverage, and you buy life insurance to back the risk that you are taking.
Yeah, because if you just do it based on term, there's not a huge amount to offset that.
Fine. The premiums are going to be 25% of what it was going to be, but still, like, fine. I'm not selling a guy $100,000 a year. I'm selling a guy $25,000 a year. I'm still making 30,000+ on that sale. Like, that's pretty good.
Yeah.
And I feel good because the guy's actually putting his money to work. Right? There's such an opportunity in the life insurance industry, in my opinion, to really change the way that the public consumes and interacts with these products. And like that's effectively what I'm trying to do. And hopefully I can get a few more advisors on board. The gentleman I met at Design Securities, Jeff, actually I was referred to him through Duca Financial, because I think I mentioned this on the last podcast, when I was getting my line of credit through them against my policy. And they sent me the loan document. It said, margin secured line of credit, non-registered investments. And I'm like, what do you mean non-registered investment? She's like, yeah, get a portfolio. We'll give you a line of credit against it. And I'm like, can I speak to this guy? Or like, who should I speak with? And they mentioned, no, this guy, Jeff at Design Securities, I think you'd really get along with him. Same age group. You seem to think about stuff in a similar way. And we've hit it off. And I've actually done a small leveraged Fort loan with him. So I threw in 25 grand, levered it up by 75, 100 grand invested. And I have a number of clients I have a lot of clients getting rid of their power policies, getting rid of their infinite banking policies, but doing the exact same thing with leverage, utilizing a portfolio, ideally with the index.
Yeah, this is interesting, man. This is good. I really respect the fact that you put the time in to kind of drill down into this, to kind of give a clearer picture with numbers behind it. I guess maybe that's I'm that type of person. I like to see the numbers, and I'm like, oh, okay, starts to make a lot of sense. We got to wrap. So for anyone,
I can keep going. I'm kidding.
No, but no, I'm just looking at the time. That I know. So if someone wants to dive deeper into some of these illustrations with you, or just talk about their policy, like how do they reach out to, who should, like,
go to my website, email me.
Okay.
Right?
So Niman Financial, Niman.
Yeah. Niman Financial. Search it in Google. I'm going to be, the next step of this, what I've built is I want to turn it into illustration software where you can go to my website. You can effectively plug in the payment schedule that you committed to with your PAR policy, and it will give you 10%. It will give you back testing to the S&P for how many years you want. It will give you the option with servicing debt and the net cash flow. So that's what I'm trying to build into the website right now. But effectively, go to my website, send me your illustration, and I'll pump that data into my modeling. Not because, I'm going to repeat this, the likelihood of you doing exactly what I ask you to do and mimicking what you're doing with PAR, exactly what you're doing with that, is not going to happen. It's just not. The likelihood of you being like, oh, because I was putting $25,000 a year into PAR, that means I'm now going to borrow, 25 divided by,
sure, some money,
$500,000. Like, I understand why you're not going to do that. I'm just trying to prove a point here that this is a poor use of your money. And unless you have so much money that you don't know what to do with, you need to be very critical of every dollar that you're investing and get it to work as much as you can for you.
And look, in my opinion, even if you never change and you end up finding out, or your belief afterwards or opinion is that you're in the right place and everything is perfect, then great. Now you just have more information to solidify that belief. It's perfect. Like we're just always looking for.
It never happens.
We're always looking for an information advantage. You know what I mean? So I just always like to just understand what's going on, and then I can decide from there. So it's not about that, but it's just I want to say that I know you take a lot of heat because you're taking a very contrarian view to a lot of other people in the industry, and I don't think you should. Like, from our conversations with you, not on the podcast but outside the podcast, my belief is that you're coming from a very good place, and you're happy to be proven wrong, like you said before, and you're trying to get all the data together to just try to make as educated decisions as possible and just share that. So I don't believe you're coming from a bad place at all. And I think you're actually doing a service for people, trying to help them just understand things at a deeper level versus just kind of the marketing materials and the marketing slogans that are given out.
Yeah.
So for what it's worth, man, I know Tom and I agree on that, and we appreciate kind of what you're doing.
Thanks.
It's kind of cool.
Yeah. Well, thanks for letting me do this. And one more thing. If you're another numbers guy, if you're a numbers person, or if you're an accountant, or if you're an advisor and you understand this stuff technically, and I'm missing something, please, reach out to me. I would love to do an open discussion. None of this, I won't talk to you bullshit, or let's have a conversation first before we may or may not record something. That just makes me think that you're a policy peddler who really isn't after the truth. I'm not saying there aren't scenarios that these don't work. I'm just saying, for people actually trying to make money, right? Give me something here. I'm trying to figure out why this is so popular. And my conclusion more and more is being that the only reason why this is so popular is because it's so popular, and it's so popular because it's so heavily incentivized. That doesn't mean that your advisor's only doing it for the commission. It's just that we have such one-track minds with these products that we should really start thinking about thinking a little bit outside the box. And the irony is that if you do, and this is my pitch to other advisors, there's still money in it for you. It's going to be different money, but I think it's going to be better, more confident money. And your clients, God willing, you stay with them until they're 100. They're going to have, I think they're just going to have so much more money. You're going to feel so much better about yourself. I just think it's a no-brainer. And I'm open to being proven wrong here, you know?
Very cool, man. Thank you so much for coming in, eh?
No, thanks for having me again. Appreciate it.